Welcome to the Explainer. Today, we're putting on our skeptical equity research analyst hats to do an investigative teardown of Extra Space Storage, ticker symbol EXR. We're acting as financial journalists right now, stripping away all the hype to look purely and objectively at their Q2 fundamentals. But before we get deep into the weeds, you gotta hear this staggering metric, 1,780%. That is EXR's 20-year total return. It's literally the highest in the entire storage sector, and the second highest among all public REITs. So let's look under the hood and see if the engine behind that massive return is still firing on all cylinders, or if it's, finally running out of gas. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Section 1. The self-storage battlefield. Let's quickly map out the macro environment. Right now, there is a stark tension gripping the storage industry. On one hand, you've got 65% of operators feeling pretty optimistic about local growth this year, but simultaneously, 59% are absolutely terrified of an economic downturn crushing demand. It's this wild collision of local confidence and deep national anxiety. The easy growth years we saw during the pandemic? Yeah, those are officially over. And where exactly is that anxiety coming from? Well, 31% of operators say new market entrants are their biggest threat. But here's the secret. Actual physical oversupply has cooled down. The real threat isn't a new building down the street. It's the permanent raising of the competitive bar by tech-enabled entrants. Honestly, if an operator doesn't have cloud software and dynamic pricing today, they're already dead in the water. Moving on to Section 2, Q2 Earnings Reality Check, let's dive into the hard numbers. Just a quick refresher for anyone newer to real estate accounting, you simply can't analyze a REIT without understanding FFO, or funds from operations. Net income can be super misleading because it includes massive non-cash depreciation charges. FFO strips all that out to show us the actual, true cash-generating engine of the business. And let me tell you, EXR's engine is roaring. They delivered a textbook beat. We're talking an adjusted EPS of $1.25 when Wall Street was only expecting $1.16. But the real headline? Their core FFO accelerated 4.9% year over year to $2.15 per share. They beat expectations on the top line, and they beat on the bottom line. Management clearly sees this momentum too. They actually raised their full-year FFO guidance up to a midpoint of $8.32.5. By crossing above the analyst consensus, management is essentially throwing up a bat signal to Wall Street, saying, hey, our internal models are way more optimistic than your expectations. Now this is the absolute key reality check of the entire quarter, the mathematical inflection point. Extra Space drove same-store revenue up by 2.4%, while simultaneously shrinking same-store expenses by 0.5%. By violently arresting that expense inflation while continuing to push revenues up, they generated a powerful 3.5% surge in net operating income. Their operational resilience? It is mathematically confirmed. Section 3, the media blackout flags. Let's look past the headline revenue beats. Welcome to our 7 and 7 gauntlet. These are the deep, structural red and green flags buried in the footnotes. Why does the mainstream media ignore these? Because things like complex integration risks and bridge loan pipelines are just way too complicated for a quick TV soundbite. But we're here to do the real homework. First, let's look at the red flags, because the bears definitely have some valid ammo here. Ending same-store occupancy actually slipped slightly, going from 94.4% down to 94.2%. This tells us their revenue growth is currently heavily rate-driven. They're mostly just charging their existing customers more. But what happens when price elasticity finally snaps? If demand softens, relying entirely on rate hikes is a dangerous tightrope. Plus, they only deployed $113 million in acquisitions against a $300 million target, simply because the open market is just too expensive right now. But flip the coin, and those green flags are seriously shielding this business. Their proprietary AI models are out there pricing 2.8 million units every single night, flawlessly sacrificing a tiny bit of occupancy to maximize total revenue. And since the open market is overpriced, They're using their bridge loan program, which just generated $400 million in originations, as a genius backdoor funnel for cheaper acquisitions. Oh, and their capital-light third-party management platform added 67 stores, printing cash without requiring heavy capital outlays. Section 4. Valuation and peer comparison. Let's see how they stack up. Running the valuation gauntlet, analysts over at Wall Street Zen currently see an average price target of $155.27. So we're looking at roughly a 5% upside from current trading levels. This tells us there's no massive hidden discount here. The market is fairly efficient, and it has pretty much already priced in these recent operational successes. But the ultimate test is putting them head-to-head with their biggest rival, Public Storage. PSA definitely has the sheer size and the one-year momentum with a 15% return. However, EXR boasts a cheaper forward PE ratio of 31.4 compared to PSA's 35.7. EXR also slightly edges them out on operating margins. What's the takeaway? While Public Storage relies heavily on their massive brand scale, EXR's tech-driven approach is just slightly more efficient at extracting margin. And this quote from EXR's president, Noah Springer, completely confirms their disciplined strategy. They are not going to overpay on the open market just to pump up their portfolio size. Instead, they're leaning into those proprietary pipelines, the bridge loans, and third-party management relationships to harvest deals that actually make sense for the bottom line. Finally, Section 5, the final investment verdict. Let's pull this all together. From a Morningstar-style perspective, EXR's economic moat is undeniably expanding. It's anchored firmly in digital intangibles, those incredible AI pricing algorithms, and the efficient scale of their massive third-party management platform. As the tech barriers to entry keep getting higher, smaller mom-and-pop operators have no choice but to tap into EXR's platform to survive, which literally just feeds EXR's scale even further. So what's our final verdict? Right now, based on that 31.4 forward PE and the 155 consensus, EXR is fairly valued. They're operating flawlessly to extract higher margins from a totally flat market, and the turnaround is mathematically confirmed by their contracting expenses. But we have to acknowledge the elephant in the room. The risk lies entirely in price elasticity. So I'm going to leave you with this to chew on. The valuation models show undeniable mathematical momentum. But those hidden occupancy flags we just dug up, they suggest a storm could be brewing if consumers finally refuse to pay higher rates. Are the AI algorithms enough to sustain this growth, or will rate elasticity snap? Dive into the data, weigh the flags, and do your own homework. Thanks for joining me on this explainer, and I'll catch you on the next one.